How the U.S. dollar system turns public debt into global power. When we talk about public debt, most people react with anxiety. The moment they see numbers in the trillions, they immediately imagine bankruptcy, recession, or chaos. But if you look closely at the global rankings, a striking paradox appears. The countries with the highest public debt are not fragile economies. They are the very centers of global power. This is the moment where we need to step back and ask a deeper question. Is public debt actually dangerous, or have we misunderstood its true nature from the start? Now let us move through each layer and see why superpowers not only live with massive debt, but turn it into a structure of influence. Many people look at the global map of public debt and quickly conclude that highly indebted countries are reckless spenders on the verge of collapse. But before we jump to conclusions, we need to take a closer look. At the top of the list are not chaotic economies, but nations holding the levers of global influence. The United States, Japan, the United Kingdom, France, and China all carry record-breaking public debt. This leads us to a much more important question. The real question is no longer why they owe so much, but why they can continue borrowing, continue shaping the global financial system, and face no immediate consequences. To answer that, we need to set aside the old frame and view public debt for what it truly is. To understand this, we must stop applying the logic of personal debt to national debt. An individual borrowing from a bank is the vulnerable party in the contract. The bank holds collateral, interest, and the power to seize assets. But at the level of nations, the dynamic flips. A superpower borrowing money is an entirely different story. The United States issues treasury bonds and the world rushes to buy. Japan owes more than 100% of its GDP, yet its own citizens and institutions willingly hold government bonds as their safest store of wealth. This reveals a reversal of roles. At this scale, the borrower is not always the weaker party. It is the place where the system deposits its trust. And from here, the connection between public debt and power begins to unfold. In essence, the public debt of a superpower is a political contract between that state and the rest of the world. Other nations hand over trust, and in return they receive the stability that the superpower's currency and institutions guarantee. For the United States, the picture is even more striking. The dollar is the world's primary reserve currency, and U.S. Treasury bonds are the safest asset in the system. When Washington runs deficits and issues more bonds, many Americans worry, yet for global central banks, investment funds, and multinational corporations, this is an opportunity. The reason is simple. They need a safe place to park trillions of dollars in national savings, foreign exchange reserves, and trade surpluses. A U.S. Treasury bond with low yield but near certain repayment is far more attractive than a volatile domestic project with high returns but high risk. And this is where an overlooked reality becomes visible. Behind the debt numbers lies a global market starved for safe assets. The United States becomes the sole producer of a special commodity, bonds backed by military strength, legal stability, and technological leadership. From here, another deeper layer emerges. Public debt is therefore not just a cost. It is a product. The U.S. issues bonds and the rest of the world buys them, binding their own financial stability to America's. China is an illustrative case. Beijing wants to reduce its reliance on the dollar, yet for many years it has held a massive amount of U.S. Treasury bonds as part of its reserves. This creates a strategic dilemma. In theory, China could dump these bonds to pressure the United States, but in practice any shock to treasuries would devalue its own holdings and destabilize the system that powers its export-driven economy. Seen this way, the power of public debt becomes undeniable. Once again, the borrower is not merely a debtor. It is the center of a web of interlocked interests. Whoever holds its debt has a reason to want it stable and strong. Once we understand the mechanism behind superpowers, the vulnerabilities of weaker economies become clearer. In weaker economies, the structure is entirely different. When Argentina, Sri Lanka, or many African nations borrow, they do not borrow in their own currency within a financial system that the world is eager to pour money into. They borrow in dollars or euros, currencies they cannot print, and they offer little global appeal. Instead of issuing debt that investors compete to hold, they must offer high interest to compensate for political, institutional, and currency risks. And in reality, a small economic shock, a drop in export prices, or a political crisis is enough to shatter the fragile layer of trust. At that moment, public debt stops being leverage and becomes a tightening noose. This is the line separating power from peril. The difference is not the percentage of debt to GDP, but the nation's ability to sustain trust in its future. To reinforce that understanding, let us look at Japan more closely. Japan shows that public debt is only one piece of a larger picture. Its debt exceeds 100% of GDP, yet the majority is held domestically. The population is aging, savings are high, and investment channels are limited. Government bonds become the natural home for this capital. This creates a stable, closed loop. The government borrows from its own citizens, spends to maintain society, and the citizens return their savings to the government. The risk of default is far lower than for a country with the same debt ratio but borrowing in foreign currency. This proves that judging public debt by a single number is superficial and misleading. But the true strategic power of public debt lies beyond finance. From a power perspective, public debt is a tool for superpowers to execute long-term strategies without seeking approval for every dollar from each generation of voters. An aircraft carrier, an overseas base network, or a military technology program cannot be paid for with this year's taxes. They are financed gradually through future taxes, future growth, and future inflation. This may sound abstract, but it is deeply practical. Public debt allows today's political system to use the future productive capacity of society in advance. That may feel heavy, but it is also the only way to build projects of structural consequence, from basic infrastructure to energy transitions. No nation modernizes with leftover budget surpluses. They modernize with trust and borrowing. However, every instrument of power has its vulnerability, and we need to be precise here. The story is not one-dimensional. Public debt becomes a source of power only when it is tied to an influential currency and a credible institution that the world is willing to invest in for decades. If a nation spends recklessly for short-term political gains, bails out every interest group, or avoids necessary reforms, the quality of its debt deteriorates. Markets will begin demanding higher yields to cover rising risk. The currency will face pressure. What was once a privileged position will slowly turn into a burdensome cycle of higher costs. This is not theoretical. It has happened in once dominant economies. At this point, the tool that once elevated national power becomes a strategic weakness. This is why debates around debt in the United States and Europe are intensifying. Not because they have suddenly discovered that debt is dangerous, but because they understand that abusing the privilege to issue debt could erode trust slowly until one day it collapses. And this brings us to the decisive point of the entire discussion. The essential point is that public debt is neither automatically power nor automatically disaster. It is a test of governance. Nations with strong institutions and credible management use debt to invest in long-term capacity, build infrastructure, strengthen education, stimulate innovation, and expand competitiveness. For them, debt becomes momentum. Nations with weak governance use debt to plug budget holes, buy political loyalty, and subsidize systems that no longer work. For them, debt becomes a delayed explosion. Seen side by side, public debt becomes a mirror reflecting the quality of national leadership. In a world where currency, finance, and military power intertwine, superpowers do not look at public debt through the fear-driven lens individuals use. They see debt as a pillar of influence. The question is not how to eliminate debt, but how to maintain the trust that makes the world continue lending to them regardless of the number printed on the balance sheet. Once we understand this, we no longer ask naively why the United States, Japan, or Europe have not collapsed. The more important question is, when does global trust begin to crack? And how will the world shift if, for the first time in decades, a major power loses that privilege? Conclusion: public debt may look like an ever-expanding set of numbers on paper, but in reality, it is a finely engineered structure of confidence, reputation, and institutional strength. Superpowers are not powerful because they have little debt. They are powerful because they are the center that the world trusts with its money, its stability, and ultimately its future. And in a world transforming faster than ever, the real issue is not how much a nation owes, but how long it can preserve the trust that allows it to owe without consequence. To understand global power, follow the money. To understand the money, follow the debt. Debt is where influence begins.